Hi, and welcome to the visualization for Forbes Top 100 Company. And just a little bit background information first. Every year, Forbes magazine publish top 100 companies globally based on five factors: revenues, profits, assets, market values, and employees. And revenue is the most important factor among them. The goal for this visualization is to figure out the relationship between factors that can possibly impact companies' rankings. The data set, let's start with the data set. So the data set includes company name, revenues, profits, numbers of employees, assets, market value, and ranking. So the task for this one, since there are so many variables here, and each of them is like, especially from here to here, they're all like individual factors that can contribute to the change in ranking. And there will be 20 different combinations, which is a lot. So in this visualization, we'll only focus on revenues against other factors. So therefore, our task is to select revenue against different variables for x and y axis and analyze the relationship between them. And our secondary task is to figure out which variable can lead to most increase in revenue. This is the data manipulation part. If you're interested, click on the link to see more details. So let's go with the insights. We'll start with the profits against like revenues. Sorry. Yes, correct. So as you can see, the user can choose x and y axis of their choice, which is very flexible. And for this slider, this is enabling a user to discover the relationship among maybe top 50, top 100, 300 of user's choice. So in this visualization, we'll stick to 500. So as we see, there's a very positive regression line here, indicating like a small increase in profit can lead to like a large amount of revenue increase. Although not a causation relationship, but we see this correlation here. So we see some outliers here, tech companies, basically. Yes. So let's go to the next one. Numbers of employees against revenues. So for this one, we'll switch to numbers of employees. Okay, just like that one, we still observe a positive regression line here, but although not as steep as the previous one. And we see these outliers. They're health companies, pharmacies, and some giant tech companies. They have like a relatively average numbers of employees, but they generate like a huge amount of revenue because they're representing like some high tech, and they're pretty expensive. Let's go to the next one. So assets versus revenues. We still observe a positive regression line here, but one interesting thing I want to point out is the outlier. So we see Wells Fargo, Citigroup, Freddie Mac, Bank of America, Morgan Chase, and this one. They're all banks. So they have like huge financial assets, but they are having a relatively lower revenue than some companies, primarily because the assets are not theirs. Their goal is just to manage these assets and make profits out of it. This explains why they have like a huge amount of assets, exceeding their revenues. Let's go to the next one. Market value against revenues. So just like the other ones, we still observe like a positive regression line here, and the outliers here are CVS Health, ExxonMobil, United Health, and Walmart. These are more of a, I'll say, more of a traditional industry. Like they're like health insurance companies, and Walmart supermarket. They all generate high revenues because their income are primarily based on sales. And for these outliers here that have like a huge amount of market value but relatively lower revenue here, they're all like just like the other ones. They're all tech companies because like as you may know, they all have like super high stock price, which means that they have high market value here. But they have like a lower revenue. Basically, this indicates that these companies maybe their primary income do not come from sales. Yeah, and there's absolutely more you can play with. You can play with more combinations or drag the slider to see more details regarding top X companies. And thanks for watching.